Well, hello and welcome, everyone. We will do our standard wait a couple minutes here until we get good, I'd say another, probably we'll get back on at 10:04 Pacific, waiting for about another 100 people or so. Be right back. Well, all right, we will go ahead and get started. Again, appreciate everyone for hopping on our webinar here on strategies to improve profitability in the current market. Let's see, just some housekeeping. We will be sending out the recording and slide deck here to all the participants. We've got a lot to cover, so we will hop right into it. We have a good group on the line here. So I'll be kicking it off. Phil Rasori with MCT. We've got Justin Grant, who heads our investor services. We got Andrew Rhodes, who's our head trader, and Paul Yarbrough, who heads up our client success group. This actually, the order here is going to be a little bit different. We will go, we will go from myself to Andrew, or actually myself to Paul, and then to Andrew, then to Justin. But just to jump into the agenda here, I'll take us through kind of current market overview. We did this webinar basically a year ago. We did several, as for those clients on the line. We did obviously several webinars as the market began to, or kind of continued to deteriorate into the first half and basically throughout the first 3 quarters of 2022. I'll kind of do a then and now comparison of where we are today versus where we were in 2022. Again, it's going to be a market kind of comparison. No question, volumes are still not good, but from a standpoint of market, kind of where we are from a market health perspective, and also just kind of year over year numbers have really begun to stabilize. So I'll review that, and then we'll talk through again the values of hedging in the current environment, and kind of what it would take this is both for those of you that are doing best efforts with volume coming back, or those of you that maybe didn't have the volume. Maybe the volume went through some of those, breached some of those thresholds that kind of made you go back to best efforts in 2022. So we'll talk through that. Andrew is going to talk through what we're seeing on the kind of the pickup that we're seeing on competitive bidding on TBA trades, and also on the AOT side. Justin will go through some of the new stuff that we've got on both BAM Marketplace and our marketplace solution for co-issue executions, which we call BAMCO. And then Paul will come back in and round it out for some efficiency in the secondary marketing department. So I'll jump right in to the next slide there. Ian, if we get perfect. So again, this was so two things are going on here. I actually took a lock volume indice graph from what we saw year over year last month, and this is, you can see just from the graphs, it's been this way year over year or worse for about a year, and sometimes far worse. And just to, again, I know the numbers are far too small to see here, but you're looking at volumes down about in total about 20%. Obviously, they were far worse year over year, a couple quarters ago. But I also wanted to put kind of the bullet points, the exact bullet points that we had a year ago on, kind of where the current market overview stood. And obviously we had, this again is end of May 2022 now. These are these bullet points. And so we had a steeply rising rate environment, declining volumes, deteriorating MBS conditions. We were still all getting used to the Fed basically, saying that they were just stabilizing. At this point, they weren't completely out. That didn't happen, of course, until September of last year, but that they weren't, really going to be buying new securities and being an active net buyer in the market. So that kind of continued to deteriorate liquidity. We saw, obviously, even though we had a relatively flat yield curve, hadn't inverted yet, but we had a relatively flat yield curve. We had very high bid offers, very high roll costs. Bid offer spreads were nasty, and then as we continued to tranche up coupon after coupon after coupon, every time we entered a new coupon, we had these liquidity issues, and so really, we had a lot of problems middle of last year, and those continued. Those definitely continued as we pushed through new coupons. So if we go moving to the next slide of our kind of current market overview, you can see that. Let's look at the graph first. This is, looking at year over year, May 2022 to May 2023. And sure enough, you can see what's happened here. It's not necessarily that volume has, dramatically improved, right? It's that it's kind of like for those of you that are hedging, and you're looking at your derivative asset month over month numbers, right? If you had a bad month the month before, even if this current month isn't great, you're reversing out, you're reversing out a not huge number, and so it doesn't, it looks more stable, right? So that's really what's going on here. By the time May 2022 came around, per the slide before, we had already hit, a market that had, was already really in trouble from a volume standpoint. And so you can see that What you're going to see now is something that's kind of a little strange, right? You're going to actually see these lock volume indices stabilize out. You're going to see them potentially get positive. You're also going to see, even in a market like this, rate term refi production go positive year over year. Very possible, right? And why is that possible? Well, if you think about last year, around this time, we had rate term refis, we're down like 94% year over year. So, and that's again, mid 2022 to mid 2021. We joked around that the other 6% didn't understand the question. And so when you think of it that you're starting from such a low point, it's kind of hard for everybody to kind of digest that we're actually going to start to see positive, positive year over year numbers, even though the percentage of the pipeline might be small. So look, that's really covers the first bullet point here. I would say one thing I forgot to put in, obviously, at our conference in March, Doug Duncan at Fannie had said this as well. We're seeing surprisingly, purchase volume surprisingly rate driven. And so that could be psychological. It could be where sometimes just the deal won't get done if it's if you get into these high sixes into the sevens in rate. But we are seeing purchases begin to track, and you can see and if you just look at the last again, this is a year graph here. I know you can't read the numbers, but if you look at that last quarter, the quarter of the graph to the far right, that's the last 3 months. The purple line, so the yellow line, little yellow line, that's the total number. And obviously it tracks very closely to the purple line, which is the purchase number, right? Because the vast majority of production is purchase, obviously. What's interesting is you can also see the purchase number is tracking kind of closely to the rate term refi number, right? And so it's very interesting. In the 20 years we've been looking at this, we haven't seen, purchases that rate sensitive. So that's an interesting kind of point there. But again, we'll continue to, continue, obviously from a volume standpoint, I think all you guys, would agree. It seems that, in the 350 10-year level, get the 5.5 coupon closer to 101. And Andrew can talk about this. Again, that's a rally from here, but we definitely seem to have a little bit better, better volume outlook, both from a refi perspective and a purchase perspective. As far as the yield curve, obviously being inverted, that is creating the financial laws of physics have prevailed there, and you're seeing far reduced roll costs versus what we saw out a year ago. Andrew can talk about how that interacts a little bit with the bid offer spread and how you might see some artificial roll costs given the bid offer spread issues. And again, really the bid offer, kind of the efficiency of and liquidity of the TBA market really rests on right now on a somewhat stable market. For those of you guys trading securities, as you know, if you go to 6.5, God forbid 7 and higher, you really start to have issues with liquidity. And so as you, like we had last year, if you continue to transition coupons, you continue to have liquidity issues. So if we can continue our albeit notwithstanding our little debt ceiling, I think we all got some good news last night. Let's knock on wood that the Senate doesn't surprise us there. We get past the everything's done with the debt ceiling. We won't have to worry about that. Without the debt ceiling little bump there, we've been in a pretty, again, fairly stable market, all things considered versus last year. But again, given the fact that the bid-offer spreads are still problematic on the higher coupons, and we'll talk about this later, assigning that trade, when you're able to, and then competitively bidding that TBA is still absolutely critical. So I think this brings us to our first audience question here, and this is where I'm going to, once we do this question, I'm going to transition it over to Paul Yarbrough, and he can kind of talk to us about what he's seeing as he brings boards new customers or existing customers back into MCT's kind of hedge process. And so the first question here is, are you currently hedging and delivering loans on a mandatory basis? And I think, there, Ian's got the, thank you, Ian. And Ian, I have to say, I forget if I'm supposed to do something here, or let me know if, oh, nope, it sounds like we are back. We're giving everybody about a minute or so. So I think that gave everybody enough time. So Paul, maybe you can take us through moving over to the mandatory versus best effort spreads. You can kind of talk a little bit about that, and then also take us through a little bit of what you're seeing with regards to some of the lenders who had, out of concern for volume or maybe just the volatility that we saw in 2022, what you're seeing. I know you're seeing some of those lenders come back into hedging.
Yeah, no, thanks, Phil. And then it looks like a good portion of the audience today is definitely hedging, but still about 10% of us that are not, a little over 10%. And so I think speaking to some of that crowd, and then even in some of the crowd that's wondering, is this a good thing I've entered into? You can see on this chart here this BE to mandatory spread, which we track and publish in our BI tool as well. But year to date, we started out the year pretty tight. I don't think that's any surprise to anybody that at the end of last year and then running into this year, where volumes were very low, that spread that we're offered from investors from a best effort rate sheet to the bulk price that we ultimately commit to was pretty tight. But then we've kind of since jumped up quite a bit. We've seen as volumes kind of come back around, as Phil Sled showed in the charts in the previous slide, that it's contracted a little bit, but we're still maintaining around an average of about 29 basis points for the year from that B to mandatory spread. So quite a healthy pickup to make it worth your while to hedge. And you can see we're trickling back up here towards the end of May, running into June, which is a good time as we conduct all our end of the month loan sales here. So yeah, and so we'll move to the next slide there and talk a little bit about what we're seeing. So like Phil mentioned, we've definitely saw some clients of MCTs that moved off of hedging, and they what we call went on pause, where they were still in communication with us. We're still helping with their data analysis and some reporting, but just weren't executing the hedge position and selling mandatory. And so we've seen a good portion of those come back into hedging because, number one, maybe their volume is back up, and number two, there's some kind of, like we just showed, healthy pickup there. So just as a reminder for that portion of the crowd that is unfamiliar, but hedging, it does allow you to manage your risk, your pull-through risk, your basis risk, rather than paying basically somebody else to do it. What I mean by paying is that if you're delivering a loan best efforts to the investors, they're going to have to margin for that as well. They have fallout that they have to manage too, and their own basis risk, and so that's a consideration for the margin that they're putting into that best effort rate sheet. So if you're managing it, that hence the pickup on that mandatory execution. So if you are conservative with your hedge, stay interest rate neutral, and which we do at MCT, like in our MCT Live hedge model, you can execute those mandatory trades and know that you'll get the pickup at the end of the day. So again, you're going to maximize that profit and receive that improved pricing, be rewarded for taking on that risk. And like I said, it's around 25 basis points year to date. It's what we're seeing as a pickup there. The other thing, improving your operations. We'll talk a little bit about this at the end of the presentation here, but you are improving the control of how you manage your locks, which is very important, especially as we're all trying to keep our production staff happy. Minimum volume out there, less to go around. You need to offer whatever you can to help control your products, your extension fees, renegotiation fees, all that kind of good stuff. Your underwriting being more generic rather than investor driven. You see those improvement in your operations as you move into a hedging strategy. The liquidity of your loans, remember, it's fungible, right? You may lock it up front with one investor's pricing, but then at the end of the day, at the end of when it's time to sell that loan, you kind of enter into a more liquid environment with that loan, because now you're not just beholden to one investor. And then obviously, like I said, extensions, renegotiations, moving from product to product, avoiding investor overlays, you get that flexibility. So you get to offer that flexibility to your LOs and keep them happy and the borrowers on board there. Typical requirements, we're still seeing some pickup there if you have about $10 million in volume and about a $1.5 million net worth. $1.5 million is a good starting point. Definitely, obviously as hedging improves your execution, bringing that net worth up into 2.5 opens new doors as well for different dealers and maybe different executions. But definitely starting out at that $10 million level, $1.5 million net worth is going to get you going. You also need a centralized lock desk and some delegated underwriting approval. So that shouldn't be, everybody on the phone here probably is aware of that, but if you need help centralizing your lock desk, listen, we have the best and biggest outsourced lock desk here at MCT, run by Natalie Arshakian and Chris Anderson. And they'll definitely can give you some advice and maybe even help you run that lock desk for you. And then obviously delegated approvals, you're going to need to be able to underwrite your loans, so you can have that fungibility between different investors as you move through the process there. So as Phil said at the beginning, we will distribute these slides, and so you'll notice that the pie chart over here on the right is a link, and will be included in the notes there once we distribute them. So we're going to move on to the next section here. And so, one of the things you're going to do is to improve your execution, even if you're new to hedging or if you've already been hedging, is making sure you're getting the best price on your loans and your hedge position. So I'm going to roll it to Andrew here, but first I'm going to ask, are you consistently getting 4 or more quotes on every TBA trade? So we'll open the poll with that. And once we close that poll up here, we'll pass it to Andrew.
Yeah, getting some definitely getting some good feedback on the on the poll there. So looks like about half of you guys have already put in um, a vote, and about 70% of you guys are doing bids with more than four dealers. So yeah, I think it really is kind of just hitting on that point of kind of trying to become as efficient as possible with every kind of aspect of the business that you're doing, right? So picking up as much as possible from a loan sale perspective, picking up as much as possible from a TBA perspective. We want to make sure that we're helping you guys maximize the potential at every at every aspect of the business that we can. So I think on the next slide we'll see some overall kind of pickup numbers just from an execution standpoint. So the bottom line here is the one in blue is what we're seeing as a spread to average. So we're looking at kind of all the competitive trades that have flown that have gone through the system, and just taking an average of those over over a year to date kind of period. And as you can see, it averages probably right around a tick of execution savings compared to the average bid that you're able to pick up by putting dealers in competition with more than four. So I think if we're looking at the max pickup, I think that's probably it's probably a little skewed that way, and that's why we kind of look at it as an average basis is probably the best kind of baseline to say that you'll be able to pick up that much by putting in more dealers in competition when you're putting out your TBA trades. And I think to illustrate that, I went back and I looked at a trade that one of our clients did back on May 12th, and you could see here from just the wide dispersion of bids that if you're not sending this out to multiple dealers, there's a big chance that you're missing out on execution. So the low bid here was a 4+. The winning bid was a 16 3/8. So your overall spread just with this one trade was close to 12 ticks, 11 7/8. So if you're calling one dealer, what's the chance and what's the opportunity that you're going to get that best bid? So it really does pay to start looking at more dealers and to start looking at, like I said earlier, trying to become more efficient with with everything that you can do in your line of business. And this is just kind of one of the ways to help you guys try to achieve that maximum pickup for each aspect of the business that you're in. So considering 70% of you guys are already doing this, that's great to hear. And I think our kind of view on it is to make sure that you're getting those approvals and that you're working with the dealers and taking business and getting business to everywhere where it's appropriate given given where they all stand. So I think at the end of the day, it really does kind of just pay to put more dealers in competition when possible, and try to maximize that overall piece of the business. Speaking of kind of maximizing the each segment of the business, I think this rolls us into our next question here. So you're maximizing everything that you can when you're setting those TBA positions, but we also want to make sure that you're maximizing your ability to your gain on sale for your loan sale side, and utilizing the AOT business from the investors that are offering it is a great way to kind of mitigate that bid-ask spread exposure that we're running into. And I think with the Fed currently not supplying or not providing liquidity to the market, we're seeing spreads continue to hold wide and to be wider on those higher coupons like Phil was talking about earlier. So just looking at the current current 5.5. So UM 5.5 is trading at par 5+ on the front month on the bid side, and then the offer side is a par 9. So just right there with the UM 5.5 market coupon, you're seeing a 3+ bid-ask spread in something that's supposed to be liquid, and for prior years has been trading inside of a tick. So looking at maximizing that potential is definitely something that we want to encourage as much as possible. So this leads us to the third question: are you actively using bid tape AOT executions? I think we got the poll going. Maybe not.
Yeah, Ian, it looks like it closed there.
Sorry, guys, I had to double click on that one. We might have to just guess.
Gotcha. Yeah, it would have been nice to get a poll. I feel, considering most of you guys are hedging, given question number 1, most of you guys are bidding out to multiple dealers, given question number 2. I'm hoping that this would also be an affirmative, call it, 65, 70% of the people on the line would also be doing bid tape AOTs. And that is a big part of what we're trying to push for just overall efficiencies on the loan sale side, because some investors are offering the AOT execution, which also provides cash flow efficiencies, but you are also achieving a better price by being able to assign that position to an investor and reduce your overall kind of bid-ask spreads. So Ian, if you want to just go to the next slide, I guess if we could just take a look at that. So once again, went through the database, pulled numbers together year to date, and as you see, we did see a pickup in volume kind of coming into April and May, just given originations in March. So we did see some additional volume being sold and pickup from an AOT perspective. So more and more investors are starting to offer this as an option, and we're continuing to work with these investors on building it out in their platform. We've had, I think there's two current investors who are working on opening up some flexibility in their AOT program, to where you'll be able to have more flexible guidelines in terms of what they're able to accept for trades, given the loan production being sold to them. So and then there's also a new investor stepping into the space, and I think they're going to go, hopefully they'll go live sometime in June, if not July. And we're excited to kind of see that and help them, dial in the program. And we're going to do our best to kind of put that in front of our clients and make sure that they're utilizing that as much as possible, because I think the numbers kind of speak for themselves. Close to 2 billion in AOTs in May, for close to 1.7 million in savings, and that's just given the way that we're calculating that is we're databasing the strike, the bid price at the time of assignment, and then essentially we're able to calculate what that bid offer spread is at the time of assignment, and that's how we're coming into these numbers. So it's not necessarily just a generic, hey, that would have been a tick, that would have been 2 ticks. We're capturing that data so we can provide accurate reporting on it, to the clients, and back to the investors as well.
And Andrew, I think this is a good time to maybe dive into a couple of questions, just because we've got a lot of content left to cover, and I'm concerned we may not get to these. But number one, I just want to underline what Andrew just said. I mean, we 20 years ago when we were doing this with AOTs, you might have picked up, maybe a tick, 3 basis points. on agency production. You can see what's happened. It shouldn't be this way, right? You shouldn't see more market friction 20 years later, but guess what? You do. So you can see, I mean, those are the numbers: 8 basis points on what should be some of the most efficient mortgage product traded, period, full stop, is an incredible spread. So Andrew, I just wanted to, we had a question from Logan here, just specific to the TAM side, any way to get the bids, eliminate the $2 million threshold. And I can answer that. We've gone back and forth, understanding that the dealers, we understand that they have costs that they incur to provide credit to clear these trades. At the same time, we also have to understand that volumes have dramatically come down versus the days of 2021. So we're continuing to look at that, talking to the dealers on ways. I think there's different dealers have different points of view on that, Logan, and I think that's probably eventually how that would shake out. Some would be interested in that. Some probably would not, and that's the same way, right, with very large household name primary dealers. You've got some that'll be unbeatable at $10 million blocks of trades, and they'll be horrible at 2 million. And so, but we're continuing to work on that. And then one thing I wanted to address, just real quick, Chris had asked if we feel that any broker dealers would ever juice their competitive bid to make the pair off on the back end. And I think it was an apropos kind of time to bring up AOT, right? That's where first and foremost that you're a line of defense against that. Also, if you are an MCT customer, obviously we represent a large portion of if not the majority of those of these broker dealers volume, and so we're watching for that. But obviously if you're ever to see that, just let one of Andrew's traders know. But yeah, sorry for cutting in there, Andrew. I just thought we had a couple of good questions, and I think we'll probably run right up to the hour on content here.
Yeah, no problem at all. Glad we glad we could get those addressed, and I think it's appropriate, right? And to what you were just talking about, this is something that all the traders are looking at on a daily basis. Whenever we're for any managed account, we're looking at trying to help out with these efficiencies at all possible times. So like I said, we'll continue to push on the investor side to get more of these programs up and running. I think right now we're 14 or 15 different investors that are offering AOT programs. So we'll continue to kind of push on that to get more investors in the mix, and I think that's just that's going to help out from an overall profitability perspective, and it's going to help the investors become more competitive as well by being able to offer that product or that offering. Ian, can we go to the next one, please? So just kind of highlighting overall year-to-date numbers, saved about 6.8 billion in trade so far. Quantify that out, that's about close to 38,000 for each of the clients. So these numbers, it's definitely not nothing. So, and that's why we're continuing to push on this and continuing to try to help help out where we can as much as possible. So if we're looking at it, just I don't think that there's going to be any more help with liquidity hitting the market for TBA production. So I think the bid-ask spreads are here to stay, if not get potentially a little bit wider, depending on where the market goes. If we're starting to trade up into the higher coupons, more illiquidity, wider bid-ask spreads. So we're continuing to keep an eye on that, and looking to assign those trades where possible to kind of minimize that overall impact on the P&L. So I think kind of leading into to Justin's section here, we're helping investors kind of roll out this AOT platform, and I think there are some investors currently in the marketplace that are set up to do AOTs. Justin, do you want to maybe talk about that a little bit?
Yeah, thanks, Andrew. Yeah, good segue into BAM Marketplace here. Ian, maybe if you want to go to our next slide here with the poll. A lot of you, a lot of our MCT clients here, I know obviously you've been on our webinars. We harp on AOT for all the reasons Andrew just mentioned. And the numbers he just gave as far as investors participating, there's still a surprising amount of investors out there who aren't offering AOT, and there's typically it's there's some back office work and on their part, there's some technology that needs to be implemented to be able to handle the all the mechanics of incorporating the trade gain loss into the bid price. And so really with BAM Marketplace, we're on top of just providing transparency and kind of a glimpse into the entire investor universe out there. We're also developing a lot of best-in-class tools for these investors to help them bring AOT and other things to market for you guys. So I know a lot of you guys now, as you're looking at new investors or looking to, are insisting that they offer AOT to be in order to get signed up. So curious here, we got this poll, just how many of you guys have gotten signed up and sold a loan to a new investor so far this year? Ian, if you want to kick that off. All right, yeah, not surprising at all. So about three out of four of you are signed up and transacting with new investors this year, and that's great. Obviously the environment is tough, and can't leave any basis point on the table, and things like AOT really help to make sure you're as efficient as possible with the loan sale piece. And again, really, our BAM Marketplace initiative, Ian, if you want to pop to the next slide here, our goal when we launched this, really in the throes of COVID, was to bring transparency to the market. We want, at the end of the day, it's our mission for you as sellers to be able to see every execution that is out there, regardless of whether or not you're approved with those investors. And BAM Marketplace really helps to achieve that. So most of you MCT clients know and are participating already. But for those that are new here, those that aren't MCT clients, totally free service here for clients. Really, it's just an opt-in to get in and take advantage. And really, we've created a systematic and efficient way for you to be able to see the other executions that are out there. So, as you're going through your normal course of a loan sale, now we've made it easy for you to be able to see those executions as you're doing your daily loan sales from those participating buyers. So, on the fly, as you're doing those loan sales, you can see, specific loans, whether there's an investor or a handful of investors you aren't currently transacting with, would be making an impact, and really have an act for the type of loan profile that you're originating. So very, very easy to see. That would give all kinds of historical analytics. We know sometimes you're busy throughout the course of a loan sale, so it's really easy to go back with our tools and look, the course of a month or 60 days or 90 days, what those investors, what impact they would have made had you been approved in selling to them. And, one of the other big differentiators with BAM Marketplace is our security spread commitment. Really what that allows you to do is transact with these unapproved counterparties. And the way we do that is via this security spread commitment. And really, as you're, seeing investors that, again, appear to be a good match, one way you may choose to start to interact with them is this security spread commitment. And really, you're getting them to honor the, basically the margin that was priced in. So all it is taking the all-in price that was offered on a loan, comparing it to the underlying security spot that they've indicated in their bid. And that's the security spread. Basically, it's a handshake agreement that, once you're approved, a week, 2 weeks from now, you'll go in and they'll respot that loan wherever the market's trading at that point in time, higher or lower, with that security spread that you locked in. But it's great. I know it gives a lot of you confidence out there that the bids that you're seeing from these other investors, who you're not transacting with, are real and legitimate. And so it gives you the confidence that what you're seeing from that investor is going to be there. And again, allows you to take advantage of somebody might have an axe for something at a given point in time. So really a novel way to interact or start the process with some of these new investors. Ian, yeah, thanks. Obviously bringing the transparency to the market here at the end of the day is going to improve your execution. Those of you who've been on our webinars, we've shown these charts before, and really once we got past COVID, I think we've kind of hung around, call it 20 basis points or so as far as loans that are getting committed to participating BAM Marketplace buyers, the list that you're getting. But, the key is that with that transparency, it can bring greater execution in times of illiquidity or certain types of loans that have less liquidity. And so just looking at a couple examples here, you can see, first chart on the left-hand side, we're breaking it down by FICO buckets, right? So, while the average is 19 basis points, you can see government loans are definitely higher. And then that average pickup definitely increases as you go lower in FICO. Obviously, not every investor out there, will go down that far. So going back to the theme of less liquidity, great example where BAM Marketplace can bring to light other investors who are out there you may not be doing business with, but should, given some of the production that you're originating. And again, other story, if you look at it by loan amount buckets, going down those spec pools, especially you go into the lower loan amounts, you'll see those average pickups that our sellers are achieving with our buyers, increasing pretty steadily. Phil mentioned, earlier last year, we spent a large chunk of time transitioning coupon, moving up the stack. We've also shown our previous webinars these same charts, but broken out by coupon. The point being, as we quickly shift note rates, what's being originated, you start to lose liquidity in, you know, the lower note rates that, you know, that were originated before, and some investors have cut off, and then vice versa as we've gone up into those higher coupons. There's definitely been less liquidity. You know, you get those larger bid-ask spreads. Investors are, you know, may not be getting as, you know, good of bids, or they're a little hesitant and price in more margin. So just a great example of some of the, you know, the types of loans you can really take advantage and leverage BAM Marketplace if you're not currently. And if you want to go to the next slide, you know, Phil mentioned BAMCO, and really we've had so much success with BAM Marketplace on the whole loan side that it was kind of a no-brainer for us to extend this functionality to co-issue as well. I know a lot of you out there, you know, have at least one agency approval. And if you look at the chart here, it's pretty staggering to us that, you know, on average, you know, an MCT client might be sending out bids to 20 different aggregators. You know, but those who have an agency approval, you know, really only looking at, you know, 1, 2, or 3 co-issue investors. You know, given that you're, you know, even more of a, you know, you've got the agency as the, you know, as the common denominator there, right? If you're fine looking at 20 investors on the whole loan side, you should definitely be fine looking at more investors from a co-issue standpoint. So back in November, we launched BAMCO, again, bringing the same concept where now those of you who are approved with the agencies and selling co-issue, or maybe you've retained and you know, are given the environment, kind of cash intensive environment we've been in, you know, are looking to pivot and start to sell more co-issue, just to take advantage, kind of the best of both worlds there. So BAMCO really brings that, again, transparency and visibility into other co-issue executions that are out there. So really a great way if you are an agency seller and you're not taking advantage of this. We've got a couple buyers currently in talking with a handful of others to come in and start being able to broadcast their price, you know, in the midst of your, you know, all the loans on your loan sale. Great way to identify who's out there, especially as of late. Just in the last month or so, we've seen multiple start to tick back up. There's, you know, there's other things going on via, you know, LMI, you know, some of the AMI initiatives from the agencies. You know, the cash window pricing is attractive, and it's a way for you to, you know, take advantage of, you know, the strong bids and get the cash. So again, really a great way, transparent way to see, just again, more executions that are out there. And at the end of the day, there's no harm, no foul. Worst case scenario, you're just validating the pricing from the investors you have is, you know, is competitive and strong. I think, Paul, maybe this is where I'll pivot back to you here.
Yeah, we'll wrap it up here. Only a couple more slides. Like Phil said, we'll hit that hour mark perfectly, I think, here. So, you know, I think, again, just to bring it back to why do you hedge, why do you take advantage of these things, and how can you, or what's the best way to do it? I can't say enough about using a good platform to maximize your execution, making sure you're receiving all possible types of executions from co-issue to NDS to your bulk trades with the aggregators with that AOT option in there. You know, one thing that you'll see from us in the future is really incentivizing that or showing the incentive of that AOT in your bulk bids, improving that functionality. And so using a platform like BAM is just going to help you achieve those executions, and then also do it with speed, right? That getting your time back in our day, as we've had to minimize our staff as volume is kind of dried up, and you know, we got to do more with less, if you will. Having a platform that improves that speed is super important. Automating that AOT, you know, it's not only that MCT has automated the piece that of the assignment of trade, where with the tri-party and with the dealer workbooks that the investors require. But we've also automated the updating your hedge, your trade blotter, right? So as soon as you've assigned that trade, you lift it from your trade blotter, your coverage is automatically updated. It's all executed in the same platform, which is very important to maximize that efficiency, making sure your coverage is right where it needs to be, especially in these fast-moving markets. Rapid commit. We've had so much success with rapid commit. We've got our own marketing campaigns around that, talking about our commitments and how much we've done through rapid commit. And thanks to Fannie Mae and Freddie Mac on that, and really providing these efficiencies to the marketplace and giving us the opportunity to leverage that. But it really just does make it easy to commit to Fannie and Freddie with just a couple of clicks there. I'm a personal user of the Right Back in the day. I used to take my colleagues and I a few hours to update 100 loans or so with 9 instances of our LOS open, just going back and forth from window to window, trying to get all the commitment data in, so our post-closing team could fire away at the collateral and getting those packages over to the investors, and automating that Right Back was a huge win for us. And the flexibility that we offer in Right Back is it's unparalleled. I haven't seen anything like it, to where selecting investor templates, writing back to custom fields, manipulating the data before it goes into your LOS based on your preferences. That's a huge time saver. All those time savings plus maximizing your execution is just going to get you the best of both worlds, where you're more efficient in your day. You're able to leverage your staff to talk to LOs, discover new products, discover new execution, and then at the same time maximizing what can you get paid on the overall, and improving the overall bottom line for the lenders is what you need out of your secondary marketing platform there. So went through that as fast as I could. I'll go on to the next slide there. And just as a reminder, we are going to send this out with notes, and you'll be able to try our calculator. For those of you that aren't clients of ours, interested in what's going on here, to learn more about it, have questions about what we've talked about today, we've got some stuff on our website, and we're always happy to hop on the phone with you as well. So and then I'll give it back to Phil here to wrap us up.
No, that was very, very well done, Paul, and Andrew, Justin, for squeezing a lot of content there into the hour. So yeah, we're right up on the hour. Look, I appreciate everybody for jumping on. Internally, we were talking yesterday, just just in that we haven't done as many webinars this year as last year, and I think that's look, that's a function of the market. Want everybody to understand, especially the clients on the line, but also for the industry webinars. Obviously, if we see more disconnects in the industry, we'll definitely be on more. Obviously there's been some interesting, FHFA announcements. There's potentially going to be, I think down the road, I think we're all running into maybe a little bit of an issue that we're going to watch with the affordability side. Those 28% and 7% numbers that you guys all hear about. So we could have some webinars on that, but just know that, especially for the clients on the line, that's obviously the reason we've had less of these webinars this year. Is there's definitely been less disconnects in the market, and hopefully we were able to show that again, albeit lower volume, obviously than the good old days of 2021, but definitely a better, more stabilized market than what we had a year ago today. So again, appreciate everybody's time, and we will be back to you hopefully soon with another webinar. Thanks a lot, guys.